Hello everyone and welcome to another one of our knowledge transfer sessions. Today we're going to talk about 1031 exchanges and Delaware Statutory Trusts, or DSTs, on rental properties. One of the problems people have when they have rental properties is when they go to sell it, the tax hits can be so big that it can really lock you in place on those. And understanding some of the tax strategies around selling rental properties is a really good, well-rounded approach for you to just have a basic idea of all your options while you're discussing what's best for your situation. As always, today's information is going to be treated as general in nature. I'm held to the fiduciary standard, and one of the issues we run into is that everyone's situation can be different. There's no one-size-fits-all solution. So just treat today's information as hopefully as good and pretty on point, but general in nature. My name is John Erickson. I have more than 17 years experience in the financial services industry. My office is in Bellevue, Washington, next to Overlake Hospital here. And a lot of my experience here is going to be in Washington State. So I'm going to talk about some more Washington State specific things. So if you're watching this video from other parts of the country or the world, that's where some of the basis of this information is from. So what we're going to do today is we're going to talk about selling a rental property. And if you've never sold a rental property before, you probably don't quite understand the problem with taxes and how it really affects that sale. So we have to understand the problem. Then you have to understand potential solutions, or doing nothing, which is actually a very fair solution. And that gives you a well-rounded approach to how you might want to deal with this. And when we talk about a rental property, I have the saying that rental properties are like a marriage. If you can go until death do you part, they're amazing. They have amazing tax benefits, amazing cash flow. Oftentimes they have amazing investment returns. They're good investments most of the time. Not every time, but most of the time. But just like a marriage, if you get divorced in a marriage, there's usually pretty heavy financial consequences to that. And if you sell a rental property, there's pretty heavy financial consequences to that, usually around taxes. Okay, and so one of the basic questions always is, why are you selling your rental property? And I work with a lot of retirees, and over time, I've had some awesome retirees who've been great landlords. And I look at their situation, and what happened was they were going to keep their rental properties forever. It was always part of their financial plan. And then they couldn't deal with it anymore. They got older. They didn't want to deal with it anymore. And what I found, especially with rental properties, that your age, your time, and effort to maintain those, it can start to be a big deal. And especially if it's not local to you anymore, or if it's a less desirable locality, a lot of people can find that they want to get out of their rental properties, but they're trapped. And I'll talk about why they feel trapped. And sometimes it's a change in law. In Seattle, we've had changes around eviction laws that have caused some people to get out of their rental properties. Over time, some of the tax benefits do get exhausted. So sometimes people want to get out because of that situation. But there's this subset of people who have rental properties that will want to get out for a variety of reasons. And once you get out, you have to understand what the problem is. And the problem is going to be really around taxes, okay? So when we talk about this presentation today, just understand, I think you have to go through multiple options on this grid to have a really good, well-rounded, informed decision. You should understand the taxes on the sale, because for some people, the sale is the best choice. You should understand the step-up basis. What are you giving up by selling this rental property? 1031 exchanges are a critical tool to preserve the overall value of a rental property without getting the big tax hit along the way. But there are other solutions, installment sales, charitable remainder trusts, and qualified opportunity zones that you could explore. Today, we're primarily going to talk about the sale, step-up in basis, and 1031 exchange options. And so let's do the math. Let's go through a basic problem you're going to run into. And the basic problem is when you sell a rental property, you're going to lose a lot of the value to taxes. And taxes are a portion of, everyone, when you make money, you pay taxes in the United States. And I don't have necessarily a problem with that. But when you look at a rental property, you can have this thing that's worth a lot of money on paper. And the second you sell it, the tax hit is so big, it materially impacts your value so much that it actually hurts your overall financial position just on that sale. Okay, and so in this example here, I have a rental property, like a home in Bellevue, Washington. 1.5 million is not a crazy number here, that someone bought long ago, and they were depreciating it because when you have a rental property and you're generating income off of it, you get to depreciate your building and reduce your income taxation. And so I was able to calculate a long-term capital gain of about $1.1 million in this example here. And to make the math easier, I had this person making $250,000 a year when they sold their property, because for things like net investment tax or a lot of the capital gains calculations, your actual income does matter to this math here. And so you go through the different taxes you pay on this $1.5 million sale. Federal capital gains, you're talking around $167,000 here. Net investment tax came with the Affordable Care Act. We're adding another $43,000 here. Depreciation recapture. In this case, I'm putting $25,000 because the IRS says we gave you all these tax breaks while you own the rental property. Now you're selling it. We want some of those back, and that's called depreciation recapture. California is always used as the poster child for state taxes. I'm in Washington State, so far there's no tax typically at the state level for selling your rental property, but you can have local closing costs, maybe broker fees. I put a 3% number there, and that number is important, that $45,000, because it's reducing your overall value. But when you try and avoid the taxes here, you can't avoid some of the local taxes or broker fees. And so I'm going to say that the number you're trying to avoid on this $1.5 million sale is about $237,000 in taxation. I would argue that's a fairly significant number. And so if you could sell the property and you could get $1.2 million, that's good to know. If you could do something else and keep your $1.5 million, but there's going to be now maybe some drawbacks, I'd want to know how to do that, and then what are the drawbacks, because that's enough money there that you'd want to look at these options. And one of the biggest problems, one of the biggest drawbacks, and people don't realize this at first, is when you sell your property, you are oftentimes getting rental income off of it. And when you sold it, you're going to take a big tax hit. And then when you go to reinvest it, say buy another rental property, reinvest it with an investment advisor, anything you want to do with that money, buy a CD. You're not buying it with $1.5 million, you're buying it with the reduced value, which means your income is now materially going down quite a bit. In this example, over 20%. And so because you get this big material loss of income whenever you sell your rental properties, that's a significant secondary factor that you have to consider protecting yourself against, especially if you need to live off this income. And that's why the 1031 exchange exists, or portion of the reason here why it could be used for you. So 1031 exchange. Basically, the IRS is saying this doesn't count for your home, no personal property. This is for investment properties like a rental property. But you can go like kind to like kind, and you don't create a taxable event if they're the same value. If they're not the same value, you have to do some other math. But basically, you can transfer like kind to like kind without creating a taxable event. And that's pretty powerful here because, and this is an IRS rule for you, but that's pretty powerful here because, what's happening here is that you are avoiding that $230,000 hit and you're preserving your $1.5 million. Now, the problem with the 1031 exchange is if you're going to real estate property, the problem is always you have to follow the rules to the letter. And the rules are pretty strict. In the big ones, the timings, you have to know where you're going to flip to within 45 days of your sale, and it has to have been purchased within 180 days, right? So all that negotiation period, you're under the gun there to get everything closed and locked down. And if you miss it, it's a taxable event, and you've now put your money into this new property, so you don't necessarily have the money available to take care of this. You have to use qualified intermediaries when you do this, and this works pretty well. And people do rental 1031 exchanges all the time, and you should consider it. The problem is going to be, especially when I deal with retirees, identifying the properties, and you're still going from rental property to rental property, and if you're too tired and old to deal with this, you haven't actually materially made your situation better. And so that's the problem with 1031 exchanges, is not that they're not valuable. They're very valuable. It's that there's very specific rules, and it doesn't get you out of the rental situation if you're aging past that. And so then we get something that kind of fixes that problem. That's called a Delaware Statutory Trust, or DST. And this is an investment pool, typically of commercial real estate, that you get to put your money into, and you get equity in that pool. And that is considered 1031. And then when it's within the pool, your property is sold within the pool, and it can be reinvested. Okay, and it's called a 1031 to a DST. And that preserves your capital gains, so you don't have to pay the capital gains taxes. It preserves your step-up and basis, so if you die with the property, your heirs could still get the step-up and basis. It generates income for you. You no longer have to manage the investment pool as heavily. You usually need a financial advisor to be a party to this. And so this is a pretty solid way to move from a rental property and get the tax benefits. Now, one of the issues with the Delaware Statutory Trust is once it's set up, it's pretty inflexible. It can be a little hard to get your money out in the short term, and in the long term, as properties are sold or moved on from, you have to. They can't reinvest within that same Delaware Statutory Trust. You have to do a 1031 exchange to a new one. So typically, what happens is roughly every 5 years, you do another 1031 exchange to a new Delaware Statutory Trust, and you just keep rotating them to preserve your tax basis. But what typically happens, especially at the consumer level, is you're probably going to go to what's called an UPREIT. So instead of doing this Delaware Statutory Trust where you flip to flip to flip to flip, you're going to move to a REIT product. It's called an UPREIT, which is a 721 exchange. And that gets you to what's a more flexible solution that might have better returns because Delaware Statutory Trusts have a little bit higher fees internally. And so that could be a way for you to once again, preserve the capital gains and move this to a more static position later on. And so that's basically it. A 1031 exchange to a Delaware Statutory Trust. I like to say it's having your cake and eating it too, because if it works, in theory, you generate your income, and you should get a quote on what the income amount should be in theory. You're not doing the work anymore, and your heirs are now going to get the step-up in basis on the property, which is great. So you avoid some of that major taxation. And so that's a way for you to move a rental property you can't manage anymore and preserve the tax basis. Now, nothing's perfect, and Delaware Statutory Trusts are, once again, not perfect either. You have to be an accredited investor before you can invest in it. There's typically fees to invest in these. You have to have someone like an advisor like myself or someone who's a broker who's selling this for commission. So those can be some challenges there. In fact, if you go online and look at these, you're going to notice it's probably big business because there's a lot of places advertising to do this because it's a common tax tool. And because you have to be an accredited investor and because you almost always have to have a middleman, it's a good, if you can convince someone to do it, it's a good way as an advisor to generate revenue, basically. So you have to recognize that if you're going to go into this route, you're probably working with someone. And if there's anything I know about landlords is so many of them are so used to doing everything on their own that the idea of hiring someone paying fees sometimes really bothers them. So recognize that there's an element of that to this. And there's no one-size-fits-all solution. For some people, the sale is the best option, right? For some people, a 1031 without a Delaware Statutory Trust is the best option. The step-up in basis is there. It's amazing if you can make that work correctly for you. You know, if you're single, you might prefer a charitable remainder trust. That could be another way to do this. And so there's no one-size-fits-all solution, but the Delaware Statutory Trust or DST route is pretty solid. And it lets you hand off some of this work to a professional and kind of move on from that position. So I hope this is helpful. I hope this is helpful talking about some of the concepts of rental properties, the taxation issue, and 1031 exchanges to a Delaware Statutory Trust. My name is John Erickson. If you want to reach out to a financial advisor who's not just a salesperson, I'd love to talk to people. You're welcome to even email me and tell me where I think I'm wrong, basically. But beyond that, I'm here to help. Feel free to email me any questions you have down the road or call me. And thank you for watching this video today.